Good morning. My name is Tanner Tompkins, and today I'll be walking you through stage two of my project, financial statement, ratio analysis, and valuation. Today we'll be comparing Lockheed Martin, which is the main company of focus with its two closest competitors, Boeing and Raytheon, in the aerospace and defense industry. Just taking a quick look at our agenda for the day. We're going to start off looking at liquidity, move into solvency, look at the turnover and efficiency ratios, the return on equity, our DuPont analysis, valuation multiples, the key factors that were driving these calculations, and then also our future considerations. So, moving into our company and peer overview, we are in the aerospace and defense industry. This really has two main types of companies that have two types of revenue streams. The first being commercial aerospace, which is really cyclical and reliant on global airline demand. And then also the defense spending, which is a lot more steady and budget driven. Lockheed Martin is almost entirely defense focused, with about two-thirds of the revenue coming from the U.S. Department of Defense, with programs like the F-35. That gives stability, but makes it dependent on defense budgets. Whereas a company like Boeing is able to have revenue from a lot more commercial flights through like the 737, which a lot of people are familiar with. Raytheon is kind of a good middle ground compared to both of these. They have both defense and commercial products. They're Pratt, Whitney, and Collins aerospace, tie it to commercial aviation, and then it also has missiles and intelligence segments that allow it to get exposure to defense. This mix allows most companies to get both revenue streams and allow them to diversify well. Now moving on to our liquidity ratios. Looking at Lockheed Martin's current ratio, we can see that it's trended down as liabilities have been increasing while current assets have stayed relatively the same. It began at around 1.39 in 2020, and it's now at about 1.13. Their quick ratio also fell, showing tighter short-term flexibility. And Raytheon's liquidity looked compressed in 2024, you can see. But a big driver was that they had a really large fee of almost $1 billion they had to pay to the Pratt and Whitney recall costs that kind of explain that figure. On the surface, it looks like worsening financial health, but it won't continue and kind of understates the actual liquidity. In normal years, the ratios are much stronger and they're expected to improve. Boeing's liquidity is thin but surprisingly stable, despite many of their ongoing crises and issues they've been dealing with. Um, Next, we will look at our solvency ratios. So Lockheed's leverage has increased over the last 5 years, as you can see, and their equity multiplier climbs sharply. This means that they're using more debt relative to equity, which is boosting the return on equity, but also raising risk. Raytheon stayed more stable compared to Lockheed and Raytheon, though it's still leveraged compared to historical figures. The company um, is carrying more debt relative to their assets than it used to, which may point to increased risk if rates stay high. But future sentiment seems to have confidence in future demand. Boeing's solvency is really difficult to interpret just because negative equity and large losses have really distorted the ratios. So it's not too meaningful to us. Boeing is really just surviving on investor and government confidence right now rather than the actual strength of their balance sheet. Then moving forward to efficiency ratios, these really inform us on how well companies are able to use their assets, which is important for defense companies such as these. Lockheed Martin shows very high inventory turnover, rising from about 16 times in 2020 to about 19 times a year in 2024. This shows strong supply chain efficiency and consistent completion of projects and being able to turn actual projects into like actual cash flow. Raytheon is more modest, turning inventory about 5 times a year, but they've still been able to be consistent. This reflects more predictable defense and aerospace, a typical cycle, you could say. Their receivable turnover is about 3, which is slower, showing cash might be tied up, and it's likely due to these longer term and typically more complex government contracts. And then looking at Boeing, they're extremely weak. Just um, being under 1 means that they're turning inventory less than once a year, which is not realistic. Just their balance sheets really causing um, issues in their figures. Overall, though, their receivable turnover still looks strong, being it's around 6. But I think it's inflated due to um, more sentiment and feelings towards or customer advances and deposits that they've been making. Then moving on to our profitability and efficiency trends. So looking at our slide or our graph on the left, we can see our profit margins, and then the one on the right, we can see our asset turnover. So Lockheed Martin has maintained stability over the last 5 years with margins consistently around 8 to 10%. Again, reflecting this defense heavy model and consistent contract with secure cash flows. Boeing's margins have also stayed, or in contrast, have stayed negative throughout the period, showing the ongoing impact of these crises that they've been facing. And then Raytheon, their margins were hit by, again, those legal charges that I had mentioned, but we can see recovery after the pandemic and after the recall with their rates around 5 to 8%. On the right, we are looking at our asset turnover trends, which measure efficiency in using assets to actually make revenue, as we just mentioned. Um, we won't go over this too much since we went in depth a little bit, just to see it graphically. We can see that Boeing is slightly improved, but still kind of lags. And then Raytheon saw a pretty steep increase. So moving forward, we are going to look at leverage and return trends. So we have our equity multiplier on the left, and then we have our DuPont return on equity on the right. Lockheed Martin has consistently high leverage, which inflates this ROE. This means that a large portion of the returns are debt driven rather than purely operational. Additionally, Boeing's equity is negative, which distorts the ratios entirely. The negative multipliers highlight how the losses and the balance sheet weakness make solvency really hard to interpret. Especially Boeing's financial structure is built on investors and government confidence. Raytheon is the most stable, with the multiplier hovering around 2 to 3, showing better use of leverage. Looking at ROE, Lockheed Martin's ROE has stayed relatively steady over the last 5 years, even as leverage has increased, showing the debt is propping up returns. Moving forward, we are going to move or look at our valuation multiples. So Lockheed currently has a trailing price to equity ratio of 20.74, below the industry average, which is about around 30, but in line with the forward price to equity from Morningstar of about 15.93. This shows the market is cautious on near-term margins, but confident in long-term demand and backlog of um, contracts. Raytheon is trailing on their price to equity is really inflated right now at 66.02, which is just not realistic because as those one-time charges that I had mentioned, they are artificially depressing earnings. But the forward price to equity of 17 is a lot more realistic and reflective of market sentiment. Boeing's trailing PE also is, again, really hard to interpret just because their earnings per share is negative. So it creates a negative PE. But the forward PE, as you can see, is 42.25, showing investors are paying a large premium, hoping for Boeing's recovery. All right, moving on, we are looking at earnings per share. So for Lockheed Martin, they had a net income of 5,336,000,000 divided by the 234 million outstanding shares, which gives us an earnings per share of 22.80. This is strong and pretty consistent with defense-focused companies that have stable contracts like Lockheed. Then looking at Raytheon, they had an earnings per share of 3.58, and then Boeing had earnings per share of negative 15.77. Again, this negative figure caused from issues with their balance sheet, and again, this low net, equity number. Going forward, just making some of these calculations easier, we'll use a normalized EPS of 14.93, which is pulled from dates before these issues were occurring. So now looking at trailing PE, for Lockheed Martin, the trailing PE was 20.74, but the forward PE was 15.93. The drop tells us that investors expect strong earnings growth ahead, and the company is fairly priced in the sector. Raytheon looks very expensive, again, as I had mentioned, just because of that low number, because of the earnings were temporarily suppressed because of the price. And then Boeing, again, they're really just facing issues with future recovery. Then the other factor that I chose to make a comparison off of was the EV over EBITDA, because it is one of the best for the defense and contracting industry. It's a cleaner multiple and focuses on operating earnings before financing and taxes. So Lockheed Martin, the ratio comes out to 12.64, which is a little bit lower than the industry average of 17, but suggests that Lockheed is cheap and that it might be undervalued. Raytheon sits at about 16, which is pretty much exactly in line with industry average. And then Boeing, their valuation is, again, cannot be properly utilized just because it's pretty much all built on investor confidence. Then moving on to our implied price using the forward PE. So looking at Lockheed Martin, their earnings per share of 22.80, in the forward industry PE of 15.93, we get an implied value of $363.26. That's slightly below their current trading price of $473.24. But suggesting that Lockheed might be slightly overvalued in the short term. And then for Raytheon, their earnings per share kind of distorts their implied price, but of 340, using the EPS for this year of 348 times the 1734, we get an implied price of $60.14 per share. This is very far from the current price of 153.34, but it shows that the market reflects that one-time lump sum. And then looking at Boeing's actual versus normalized, we can see that both are very far apart, but we can see that using the normalized, Boeing is trading at very high of a premium, and that investors expect a higher return if it was at a similar multiple as it has been in the past. Then moving on to our implied price using enterprise value over EBITDA. We use EBITDA multiple for our calculations. We multiplied the EBITDA by the multiple, subtracted debt, added cash, and then divided by the shares outstanding. Lockheed Martin comes in at about 12.6 times EBITDA, which gives an implied share price of about $307.62. That's an reasonable reasonable discount relative to the broader industry. And it suggests that it's trading near fair value or slightly undervalued. Raytheon, on the other hand, is trading at about 16 times EBITDA, which implies a value of about $79.49 per share. Compared to the actual price of $152, this means investors are once again pricing in recovery. Then looking at Boeing, their EV over EBITDA of negative 24.57. Due to the operating losses, it gives us a value of $37.49 per share. Not anywhere close to the $150 per share, but again, this is all reliant on future confidence. All right. Then moving to the next slide, just kind of summarizing our implied valuations and kind of the key components. Current PE, forward PE, and the EV over EBITDA multiple. Looking at Lockheed Martin, we can see that it's trading reasonably close to fair value, with no big disconnects between the actual fundamental balance sheet and the market pricing. For Raytheon, the variations are much more vast, with clusters being around $60 to $100 a share. And then Boeing, the picture is really distorted just because of those negative earnings, and they're not as meaningful to us. We're getting outputs like 37, and it's really just difficult to judge and value companies that are in situations like Boeing. Looking forward, just kind of trying to explain some of the reasoning behind these metrics or these values and valuations that we arrived to. This slide highlights each company's performance and valuation. For Lockheed Martin, it's really a story of strong defense and consistent contracts and in demand from the US and their allies. For Raytheon, it's really been recent results being dragged down by that recall and the one-time lump sum. As those roll off, we hope to see more recovery and increased profitability. And then Boeing is really weighed down by many factors. They've had many issues over the last 5 years with safety on the 737s, labor strikes, or supply chain issues. It's been rough for them, but investors still have confidence and expect Boeing to bounce back. Lastly, what is affecting all of these, which is our macroeconomic factors, defense budgets, high interest rates, high inflation, and increased global conflicts. They're all shaping how the defense and aerospace industry is functioning, and the overall cost structure and longevity as a whole. I'll quickly just go over some final analysis. We mentioned pretty much everything. Lockheed Martin, Boeing, and Raytheon. They're really big players in the defense industry, and it seems like investor confidence is pointing towards further continued spending in that industry. Then looking at our last slide here, our future considerations. As we look forward, there are four key areas that will shape these companies. Defense budgets with the U.S. and allied defense spending remains a reliable growth driver, especially for Lockheed and Raytheon. Also, operational efficiency with Boeing's turnaround, depending on fixing their production and supply chain issues, while Raytheon needs to move past this recall. Then also macro risks, as I stated, inflation, interest rates, and geopolitics add pressure. And lastly, looking at investor sentiment, which is crucial as markets are still pricing and favor recovery of these companies to continued spending into the future.